well, we are at 5 o'clock, folks. So for those that have gotten on promptly, let's begin. All right. So good evening, everyone. We're going to start this up here. But first things first, got to do the disclaimer. Let's see here. So as always, we are presenting information that we've gathered through our due diligence. You are encouraged to do your own. This is not the official offering. That's going to all occur later, where we'll let you know how to log on to the portal, read over the private placement memorandum and the subscription agreement. So we'll touch on that later in the presentation. Quick introduction. For those that don't know me, my name is Rick Martin. I'm the founder of Fortress Federation Investments, and we provide value-add multifamily opportunities in the Southeast, Texas, and Arizona. Fortress Federation is currently a general partner in 2,200 units and continuing to grow. So tonight we are presenting the Madison at Bear Creek, which is an 180-unit complex built in 1982 in Northwest Houston in the Bear Creek submarket. Skip over that. We're joined by Rob Beardsley, co-founder of Lone Star Capital, and happy to say that this is our 5th time partnering with Lone Star. Rob will soon introduce his team himself. He's going to review the investment deals and details and the business plan. We're going to try to get through this presentation no more than about 30 minutes, and then we're going to open up to your questions. So hopefully you brought a few. First, a review of the executive summary. I'm going to cover this, Rob, and then I'll pass it over to you. As mentioned, Madison at Bear Creek is a 180-unit complex built in 1982 in Northwest Houston in the Bear Creek submarket. It's traditional workforce housing surrounded by a similar product, so there are numerous properties to compare to, and we'll get into the comps later. Interesting about Madison is that the seller has owned it and self-managed it for over the last decade. He's now retiring. He's moving on to Florida into the sunset and selling off his portfolio. While he did a good job maintaining this property, he left the unit interiors 100% untouched, which is probably my favorite thing about this deal, because newly upgraded interiors and amenities are what attract good tenants. So this leaves a ton of value that we ourselves can add. So we're going to up the desirability with luxury finishes, including quartz countertops, black appliances, tile backsplashes, new flooring, new hardware, lighting, and another key is we are adding washers and dryers to all the units, as well as smart packages, smart door locks, and climate control. Regarding the unit mix, it's 59% one bedroom, 10% studios, and 31% 2 and 3 bedrooms, with an average square footage of 769 square feet and an average rent of just over $1,000 a month. Now, key to winning this deal was Lone Star had the Timberwalk apartments under contract right next door and had a great relationship with the broker selling the deal, which contributed to us securing the deal. The submarket of Bear Creek has been strong with 13% rent increases over the last 12 months and projects over 4% rent growth over the life of the hold, which bodes well for our projections as we underwrote 3% rent growth for the life of the hold. Bear Creek is a very stable middle workforce housing type of submarket. It's got a median income of $48,000, and this translates to a 4-to-1 or a 4x affordability ratio, meaning their incomes are 4 times their rent. And lenders like to see at least 3-to-1, so this tenant base can more than sustain any rent increases. And then finally, for me, a comment on the debt structure. Because of the low 63% leverage and a lengthy 7-year term, this loan has a great deal of downside protection, and Rob's going to get into that in greater detail. So Rob, take it away. Go ahead, introduce yourself and the team, and yeah, take it away. You have
Yeah,
control,
thanks,
yeah?
Rick.
Are you able to control?
Uh, we'll see.
it's always a, it's always kind of a, you know, an unknown with these things. Go ahead.
Yeah, well, thanks everyone for being on tonight. My name is Rob Beardsley. I'm the founder of Lone Star Capital. We're a nearly 5-year-old multifamily owner operator based in New York, focused exclusively on Texas. The vast majority of our portfolio is in Houston, and we actually, as Rick mentioned, recently acquired the property next door to Madison and Bear Creek called Timberwalk Apartments. And before that, we owned Verandas at Bear Creek down the street from these deals. So we have a lot of experience in the Bear Creek submarket, have done very well here, and it's a market that we're excited to be buying back into as we actually sold Verandas at Bear Creek earlier this year. So with Timberwalk and Madison, we'll now have 480 units back in the submarket, and we're very excited about that. We also have vertically integrated operations. So we launched our own in-house property management company called Radiance Living, and Radiance Living is Houston-based. So we have a corporate team that manages our portfolio, and we have multiple regional managers, meaning we can be very focused and very hands-on rather than spreading ourselves thin across many assets with few regional managers. So that's one of the benefits of being vertically integrated is we can really be a lot more hands-on. So as I mentioned, I'm one of the founders of Lone Star. Kent, my business partner, previously was a tax attorney at MetLife, and now he oversees the operations for us at Lone Star, including being the CEO of our property management company. Myself, I'm on the acquisitions and capital markets side. I work very closely with our director of acquisitions, Charles Waldron, who together we've all spearheaded the acquisition of over 300 million in multifamily assets in the past 4 years. And in addition to that, we have arranged hundreds of millions of dollars of debt as well. And we're also responsible for raising on the equity side as well. And then Josh Hoffman, our asset manager, is really a rock star. He doesn't get nearly enough credit. You may have seen him on one of our quarterly asset management or portfolio analysis calls, or you may have received a monthly investor update from him. But he and Kent are the ones making everything happen at the assets. So this case study is one that we highlight on most of our presentations, but tonight this is even more applicable to the deal we're talking about, Madison at Bear Creek. That's because this deal is down the street, so it highlights our experience in the market and our comfort with the tenant base, the growth that we've firsthand experienced in the submarket. All very positive things, making us very confident and excited to be buying back into the market. So specifically, Verandas was a property that we acquired in June of 2019. It was one of our first few assets in Houston. It's a 160 unit property that's built in 1982. So similar product type as Madison at Bear Creek. However, when we acquired Verandas, it was around 80% occupied. So it had 20% vacancy, and it was really due to the management that was neglecting marketing and operations, leasing. So upon takeover, really without spending much CapEx, we were able to aggressively market the vacant units and improve operations such that we were able to lease up actually at one point to 100% occupancy, and then have maintained over 95% occupancy through our hold. And that was aided by the fact that this street in particular has an average occupancy of 97%. So that's another really strong part about this submarket of Bear Creek, is that the tenants are quality workforce housing tenants, and they're sticky, and it's a very tight market with no new supply. So there's big demand, and all the deals in this pocket stay full, which adds to the downside protection that we're looking for. So with Verandas, once we go ahead.
I was going to say, go ahead and advance on your own. I think I got it figured out.
Okay, great. I will in just a moment.
All right, sorry.
So with with all that being said about Verandas, once we leased up the property and added washers and dryers, we were able to see pretty strong rent growth, and then we were able to exit in about 3 years for a 36%, roughly 36% gross IRR, which delivered a 30% net IRR for our investors in that deal. Yeah, it won't let me advance to the next slide.
Damn. All right.
We can skip over Cranbrook
All right.
and we can skip over testimonials.
Oh, you want to go back to that?
Track record.
Yeah.
Yeah, so track record, feel free to review this on your own time, but you could see as far as the location column, all of our assets except for one is in Houston. The landing is actually for sale as well. And, Rick's an investor and a partner in the landing. So we'll actually be selling the landing, closing on it, and 1031 exchanging the gains from the landing into Madison at Bear Creek. And that's going to be exciting for many reasons. Obviously, the 1031 exchange is going to be great, but also strategically for Lone Star and Radiance Living, selling out of Lubbock and being able to refocus our team to just Houston is going to be tremendously beneficial. We currently have team members that are on flights to Lubbock to manage that asset, and that will alleviate that and allow us to keep our focus. So that's very, very exciting here on multiple fronts. You can go to the next slide. So Rick introduced kind of the highlights of the business plan as well as the debt, but I'll just cover some of the main points again. As Rick mentioned, the biggest opportunity here is the fact that the interiors are 100% classic, which is extremely rare given that most properties of this type have been already value added by sponsors like us that go in there and programmatically renovate units. So because this property has been owned for over a decade and those units really haven't been touched for that time, it provides a huge opportunity to create a ton of value through interior renovations and mark rents to market. And we have some good comps to target for that as well. In addition to our interior value add, as far as renovations, we're also adding washers and dryers into all of the units. Currently, the vast majority of units have connections, but no machines. So we will be making connections where necessary, as well as adding the actual washer dryer machines themselves, which will not only add value and allow us to raise rents, but it will also attract a higher quality tenant base, which is typically more family oriented, which reduces turnover as well. And then on top of that, the smart home package is a smart thermostat and smart door lock package, which kind of enhances the luxury appeal of the property and makes it stand out from the competition as far as leasing. And to round out our value add plan, we are budgeting for 65 carports, which will yield $50 per month in other income. And so that rounds out the value add plan and pushes the other income. Before we talk about the target returns, I'll also revisit the debt that Rick mentioned. We are doing a low leverage 7-year bank loan on this deal at 63% loan to cost. So that is very conservative, provides a lot of equity cushion and mitigates downside risk, not just from a debt service standpoint, but also from a loan maturity standpoint. Because it's a 7-year term, we're not necessarily under the gun forcing ourselves to have to sell or refi potentially when the market is not favorable to do so. And then similarly with the lower leverage loan at 63%, it makes it easier to refi out of the loan in the case that we need to down the road. The loan also features 2 years of interest only, which helps maximize cash flow in the first couple of years, but then the remaining years are amortization or amortizing, which pays down the principal of the debt every single month, which further reduces the risk of the deal. So very conservative debt, I think it's appropriate at a time like this. And it's exciting that because of the very strong value and opportunity of this deal, we don't really have to lever up with high leverage debt in order to target strong returns. We're still able to project, nearly 16% returns backed by this very conservative loan structure. The interest rate is floating at a 2.75% spread over SOFR. SOFR today it's the industry standard short-term floating rate index, and it stands today at 2.3%. And it's currently projected to kind of go into the low to mid threes over the next year, and then slowly be eased as the Fed moves out of their tightening cycle and into their easing cycle sometime next year. However, we are purchasing a SOFR interest rate cap at a 3% strike rate. So that what that does is that puts our all-in interest rate max, our max potential interest rate at 5 3/4, right? Because that's the SOFR at 3% plus 2.75% spread. And at 5 3/4, the cash flows are still, they're not affected that much because we're pretty conservative with our projection. So that's good to see. And that interest rate cap that we're purchasing is a 2-year cap. And we're also budgeting upfront for the purchase of the replacement cap in our year 3 projection. And then thereafter, we'll have that escrowed out of cash flow. So we maintain the ability to repurchase interest rate caps to keep that protection ongoing. This deal, as with all of our deals, we have I can't say all of our deals, but we generally speaking project a 24-month stabilization period to make all the renovations happen. This is very conservative, as most of the time we're able to actually finish the business plan sooner, create value sooner, and create higher cash flows quicker. After stabilizing the asset in roughly 24 months, we'll then look to sell or refinance the asset, just depending on what is optimal based on property performance and market conditions.
Hey, Rob, just quickly, for those that don't understand, can you just quickly kind of explain how you bake in the forward curve into your underwriting so that these returns are actually net of that SOFR?
Yeah, so nobody has a crystal ball, so we don't know where interest rates are heading, but the market forecasts where SOFR is going, and that forecast is done by all of the traders in the market that are making bets about the future of interest rates. So you kind of have the brightest minds projecting out where interest rates are going to be, and we take that forward curve projection and we layer that into our monthly cash flow analysis. So every month we're factoring in what the market believes to be the future of SOFR. And so our projected cash distributions are taking into account the projected continued rise of interest rates into next year, and then a modest decline in interest rates in kind of the back half of the year and stabilizing thereafter. So that's how we model this into our pro forma. So we are, with all that being said, we are targeting a 15.8% net IRR for investors after a 3-year hold period. And that equals a 1.53x equity multiple, which just simply means if you calculate all the cash flow and the appreciation on the back end, summed up, that would mean that a $100,000 investment would turn into $153,000 after the 3-year projected hold period. Class A shares follow our traditional waterfall structure, which includes a 8% cumulative and compounded preferred return, followed by 100% return of capital back to investors. Thereafter, there's a 70-30 split. So that means the remaining distributions are 70% to investors and 30% to the sponsor. That goes up to a 15% IRR. After investors have achieved a 15% IRR, the remaining distributions are 50-50. So this is a very competitive structure that really puts investors first as far as a preferred return that is not only cumulative, but compounding, and also subordinates the promote to a 100% return of capital. So this means investors get all their risk off the table by way of getting their original investment back and their minimum return of 8% over the period. And only then does the sponsor begin to participate in the profits. Class B shares follow a similar structure and are available at a minimum investment of $500,000. And the Class B shares have a 9% cumulative and compounded preferred return with the same 70-30 split thereafter, but there's no 50-50 split over 15%. So it's a bit simpler and a bit more favorable.
I just want to quickly say, if you all have questions, make sure you put those questions in the Q&A there. You should be able to identify that. And we'll get to those at the end of the presentation.
Cool. So here we can show you a few pictures of the current condition of the units. The two pictures on the left are representative of all of the units at Madison and Bear Creek. They're in good condition, but as we discussed, they're virtually untouched. As you can see, there are no hardware on the cabinet fronts. There's old flooring, white appliances, and all of this can be transformed with adding in quartz counters, new appliances, new flooring, paint, hardware, lighting, and then of course the washer and dryers machines being added to the units, as well as the smart home. So you can see on the right, kind of the two right pictures showing the intended upgrades, and really it completely transforms the interiors, including the backsplash in the kitchen.
Yeah, I think, we're lucky in this case that we get to spend the money on the stuff that counts to tenants. Tenants don't, of course, they need plumbing and good electrical, but they don't really care about it. When they walk into the unit, they want to see nice quartz countertops, nice flooring. They want to see good amenities. So that's what's kind of unique and nice about this deal.
Yeah, and you can see that you can go to the next slide also, but just to make a point, the demand for the upgrades is very clear, as many properties nearby are experiencing similar upgrades. And also this property is 98% occupied right now, which shows you that the rents are too low and the tenants would be willing to pay more in rent given these upgrades. Even without these upgrades, we have comparable properties that are at much higher rents.
Yeah, isn't the property next door like or it's getting $100 more with the same sort of classic interiors?
Exactly. Yep. Really shows a strong case for the current condition and current basis. And then there's another property across the street called Town Lake, which is half renovated. And those renovated units are essentially what we're targeting our pro forma rents to hit across over 24 months. So on the exterior, this property is, like we discussed, a 1980s vintage asset, but it has all the bones that you'd like to see from a quality property, such as copper wiring, and the plumbing is copper with PVC, and there's also individual HVAC. So everything is in good condition, roofs are in good condition. We don't anticipate any problems after having done our inspections. The property has a fairly standard amenity package comparable to the other properties on the street. Have a pool, of course, which we'll be making some enhancements to. The laundry room also can potentially be repurposed after adding washers and dryers throughout the entire property. This is something that we've done at our other properties, where we've taken a small space, such as a laundry room that is no longer needed, and repurpose it to some other highest and best use. Something that we have been having success with is turning a small space like that into a pet spa, which is more unique and definitely stands out when potential residents are having a tour. So as far as the submarket, we discussed kind of the recent powerful rent growth that we've been experiencing here in this submarket firsthand, as well as in other submarkets across our portfolio. And rent growth is projected to far exceed our projections in our underwriting. So that's some upside that we could potentially benefit from as the market is experiencing elevated rent growth over the next, at least like the next couple of years. And we have found that because of the lack of new supply in the submarket and the workforce nature of the product and the tenant base, rent growth has been pretty robust over the last 3, 4, 5 years in this particular submarket. The other thing that this slide mentions that I think is really important is the fact that even after our renovations, our post-renovated rents are still going to be $400 to $700 less than some of the newer product and Class A product in the market. So we never want to be at the top of the market and compete with new product. And this shows that we have good headroom, and we still represent a discount, a quality product at a discount to the newer, nicer properties nearby. So Bear Creek is, in the outline, it's part of the Houston Metro. It's not in the inner loop, so it's very commutable. Yet it is also walkable to local retail, which we'll show in the next few slides. There's some good retail down the street, which provides some stable jobs in the neighborhood. And as you can see here, just right across the street, you've got your typical retail. And then generally speaking, though, the pocket is very residential. So to the west, you have homes from 250 to 290,000, and another single family pocket to the east as well, with homes going up to $350,000. And here you can see we're right off of Highway 6, which can take you south down to the energy corridor. It's easy to get to the airport and pretty much anywhere around into Houston. And there's, with energy corridor, there's 60,000 jobs 10 miles away. I'm not sure how far it is. I think it's even less than 10 miles. I think it's 5 miles away. And so that's a big driver for this area.
You got Starbucks within walking distance. It's always good.
Yeah, absolutely. And it's, you can see actually really well from this picture, just as you go south down Timber Creek Place Drive, that's Timberwalk right there to kind of the southeast of Madison at Bear Creek. So you can see they essentially share a property line. So something important to note is this is, while this is not factored into our analysis, we absolutely do plan to take advantage of the fact that Timberwalk and Madison are next door to each other. And that will allow us to actually reduce payroll on both assets and improve operations across the 480 units in total. So we didn't budget to have lower payroll than if this were a standalone asset, but we will certainly look to take advantage of the economies of scale. So as far as the comps, we talked about Bear Creek Crossing just being a couple doors down and it having 100 plus higher rents, even though it's in comparable condition. So that really helps shine a light on the value or the ability to mark the rents to market even before renovations. And then Town Lake, which is comp number 4 across the street from Madison, is partially renovated, and the renovated units at Town Lake actually have a waiting list. So Town Lake is full, and that just means the rents have room to go up, and those rents support our post-renovated rents. So yeah, so you can review some of these comps in further detail. On the sales comp side, we're purchasing Madison Bear Creek around $115,000 per unit, and this is pretty strong basis in my opinion. There's been some sales in the area that make this basis pretty compelling. I think the most compelling part about the going in price is the cap rate of 4.7%. Typically, lately value add deals have been selling in the 3s, as I'm sure many of you know, and to see a deal sell for a 4.7 cap going in on actual numbers and still have this much upside is really a fantastic value and helps with downside protection, because the higher you're going in cap rate, the more income you're buying day one, and the less you're relying upon your business plan to generate income for the property. Of course, that is our goal, and we do project to increase the income substantially, but the higher the going in cap rate, it just it helps with day one yields and downside risk. On the pro forma, this is a typical pro forma for us where we have a 24-month stabilization period. You can see that in the first year, we're projecting to increase revenue just 5%, which is our usual pretty conservative year one estimates. And you can see that's in part driven by us projecting to increase vacancy as we get into the business plan. So you can see current vacancy is around 47,000 on the trailing numbers. And then we're projecting year one vacancy to be around 116,000. So as we push rents, create turnover, renovate units, we'll be increasing the top line, but also having a higher vacancy, which continues into year 2. However, by that time, we'll have increased other income through the washers and dryers, the smart home tech package, and the carports. and also increase top line rent through our renovations as well as organic growth in the market. And that's what allows us to create a lot of this value here and appreciation.
Yeah, Rob, going back to that going in cap rate, I'd just comment that most of the stuff I see these days, I see a lot of deals are sub four, in the major market. So 4.75, right? Going in.
4.7.
4.7. Oh, well then, it's very attractive.
So this is the CapEx budget, and there's actually a question from Andy here about deferred maintenance. So we really didn't observe any substantial deferred maintenance at the property, specifically related to roofs. I forget how much exactly roofs we got somewhere here, but we've got only 55,000 budgeted for roofs, so we really don't see roofs being a major issue here. What else? How are we budgeting for carpet flooring replacements? That is included in our turnover budget as well as our ongoing CapEx. So we don't have a specific budget for recurring carpet and flooring. Andy also has a question also, which I love, about the cap rate methodology. So
Maybe,
yes, we do.
How about we repeat that question so the other guys can hear what he's asking? I'll ask it and go ahead and answer. It looks like going in cap rate is based on T12 income and year one expenses, which is a conservative methodology. Good thing. Is this how you determined the going in cap rate?
Yeah. So it's a great question. It's a good spot. And yeah, that is how we calculate our going in cap rates. And the reason why Andy's pointing out that is a good thing is because we're taking the trailing revenue, right? Which revenue is revenue. There's not much you can do about it. And then what we're doing is using our pro forma expenses as the expense assumption for the cap rate value. Mm-hmm. And that is because we don't want to use the seller's expenses necessarily, because the seller could have weird expenses for any reason. He could have, or they could have, very low payroll because they could be understaffing the property. They could have low repairs and maintenance because they could be neglecting the property. They could have low insurance because they're underinsuring the property. So it's really best to use your projected expenses as to how you would run the property to evaluate the true income going in on the asset. So that is how we do it, and that's how we are at a 4.7 cap. As you can see, if you go back a slide, the seller does actually have pretty low payroll, which is somewhat surprising. So you can see if we did use the seller's expenses, the going in cap rate, it's not really the going in cap rate, but the trailing cap rate on the seller's expenses is over 5.5%.
All right. Should we finish up and then get back to these questions, or?
Yeah, we're pretty much done. So we'll wrap up and then answer questions.
All right. Before we get into, and by the way, if you guys want to go over this sensitivity analysis, that's all there for you to review in the slide deck, which you have a copy of. And yeah, before we get on to the other Q&A, just want to let you know that tomorrow, we'll be sending out a link to this recording. You can review the slides, as I mentioned, and if you're interested, you can reserve your spot in the deal by hitting the button that says soft reserve. In fact, I'll copy and paste that link into the chat here shortly. So the reserve is non-binding, but it does let us know your interest, and we can temporarily hold your spot, but then we'll follow up with you and provide a link to the portal where you can read over the private placement memorandum and subscribe to the deal. You'll also be provided funding instructions on the portal with our funding deadline, which is scheduled for September 9th. If you are interested, I would not procrastinate, as deals normally get funded comfortably before the funding deadline. And for those that have not placed their soft reserve, I encourage you to go ahead and move forward and do that. Now, once you've invested and become a partner, you'll be receiving monthly progress reports on the property as well as quarterly financials. You'll start receiving monthly distributions after the first full month of ownership, and your preferred returns begin to accrue from the day of closing. Pride ourselves on communication and transparency, so we're always available to answer any questions or address any concerns. If you need to get in touch with me, there's my contact info. You can take a screenshot of that. Maybe I'll copy and paste my Calendly link in there in case you have any questions. So I think with that, we're going to move on to the Q&A. Before we jump in, Rob, I got a question for you. And this is for those that are doing the 1031. I know they're curious. So for those that are coming over on the 1031 and wanting to invest in more funds, how will that be facilitated?
Yeah, so we're doing it a bit differently. We have a Google form that investors can fill out. Also, a simple email works just the same. So essentially, for those that invested in the landing at Pinewood Park and want to exchange their funds into this deal of Madison Bear Creek, and on top of that would like to add funds. And the reason why this add fund feature exists is because some people like to kind of top up their investment. For example, if they invested $100,000 in the landing and now they're walking away with $135,000 from the landing sale, they may want to add an additional $65,000 so that they can top up their investment to $200,000 even. So if you are interested in doing that, the easiest way to probably do that is just to email Rick and just say, hey, I invested X into the landing and I'd like to top it up to Y, right? Mm-hmm. So if I invested 100 and I'd like to top it up to 200. And the reason why that's the best way to go is because we won't know what that top up number is until all the sale, this is finalized, right? It's going to be some uneven number. So once we have the sale numbers finalized, then we'll be able to reach out to investors with the amounts and wiring and information to then hit that even top up number.
Yeah. All right, cool. They do have the form, but yeah, people can always reach out to me and let me know if you're interested in rounding up your investment. So all right, Michael Hadries. Welcome, Michael. We got a question from you. In the pro forma, what is the annual rent growth projection?
It is 3%.
Mm-hmm. And the projected reversion rate, cap rate, exit cap?
5.25%.
Mm-hmm. So it's it's a good conservative jump from the going in cap rate. Can you touch on the insurance expense conclusion? Is it in a flood zone?
Yeah, this property is not in a flood zone. So insurance is nothing out of the ordinary here.
Okay. Got a couple more. Yeah, one had a question about the flood zone. Did you do a cost segregation? Do you know what the bonus depreciation year one might be?
Yeah, we, like all of our properties, we'll be doing a cost seg report shortly after closing, and we'll be electing bonus depreciation for 2022. So for year one, we're anticipating roughly a 50% depreciation ratio. So for a 100K investment, there should be around 50,000 in depreciation for 2022.
Okay, good. Is it the original plumbing and electrical? If so, what sort of shape is it in?
Yeah, it's the original electrical, and which we will actually be replacing the breaker panels on the interiors as well as the exterior panels. The plumbing has been partially replaced with PVC.
Okay, cool. And then, of course, how much are the GPs investing into this deal?
So us personally and with employees, we have an employee reinvestment program, as well as family members of the principals. We're targeting around $1 million co-investment.
Okay. And I am putting into the chat both a link to the soft reserve form, this one on top, and then if you want to have a conversation with me, you can hit that Calendly link as well. We did pretty well on time. If anybody has any more questions, now's the time. Gonna give you a little moment here. Got anything else you want to ask? Going once. All right. Cool. Well, a big thank you to everyone attending tonight. Definitely thanks, Rob, for coming on, getting into the details. Definitely appreciate everyone's time, and enjoy the rest of your evening. And if you're interested, definitely you're gonna find the next steps in your email tomorrow, and we look forward to partnering with you. Thanks, everybody.
Thank you. Bye.